Let's get across the market open now. Matt Schwartz joining us from Lincoln Indicators. Matt, great to have you back on the show. Let's start on Wall Street. Clearly, the focus on Nvidia, highly anticipated result, and it delivered again.
It sure did. Before we get into the minutiae, I think, of the Nvidia result, just a recap on US markets. It was a fairly flat session overnight. The S&P 500 and Nasdaq effectively moving sideways, and the Russell 2000 only modestly down about 15 basis points. From a breadth perspective, it was actually quite different. 65% of the names in the S&P 500 were actually higher, which was potentially or perhaps a positive signal for Aussie markets today. And it was the large cap players, interestingly enough, overnight that were sort of dragging down the broader indices. Nvidia was off before their result. Amazon, Tesla, Eli Lilly, all in the red over the day. And under the surface, it was tech hardware that really was the best performing industry group. And the software stocks, again, continued to nudge higher, and they're up some 25% over the rolling month. But let's get to the Nvidia result. And again, I think at a headline level, it was another beat. And it needed to be, as always. Nvidia's obviously a very well-owned stock, but revenue guidance was comfortably ahead of expectations. The second quarter 27 revenue number was some 96.2 billion, up 106% on the PCP and 18% sequentially. Gross margins were flat, but at 75%, which is still robust, and earnings was a comfortable beat. So at face value, call it another blowout beat, and it validates that bullish argument that the capex cycle and AI boom has a very long runway for future growth. And Nvidia, interestingly enough, is trading at a discount to its 5-year average relative to the market. So the bulls will make that argument. The share price potentially has a long way to go. After hours, trading has been quite volatile. I think the stock was off about 3% when the result first came out, but now looks to be trading at about 5% higher. Now, there's probably something in it here for the bears. If we really sort of look through the result, operating cash flows was significantly lower than the first quarter. I think accounts receivable days outstanding were up 60 days from 45, and inventory also increased sequentially. So perhaps the bears are sort of thinking about working capital issues. And the guidance for gross margins into the third quarter was lower than this period. So again, I think the bears are concentrating on potentially margins having peaked. And I think the interesting part of the results and the detail that management provided was, again, that circular financing and round tripping thematic that a lot of the bears are honing in on at the moment. The company did announce that they would guarantee a whopping 105 billion related to that AI data center campus, Ohio for OpenAI. And it just shows how deeply Nvidia is becoming embedded in the financing and infrastructure AI boom.
Yeah, clearly that is a concern for investors, and circular financing plus capex. Yet they continue to be impressed, obviously, by Nvidia's result. Matt, elsewhere on a macro front, there was an eye on the latest inflation data with Core PCE. Was that pretty much in line? We did see the Treasury yields tick up.
Yeah, I think it was pretty much in line. I think relative to expectations, the PCE number was in line, about 0.2% increase on a month-on-month basis from the previous year. But look, I think that the reaction in money markets has been somewhat different, and the probability of a additional or a rate hike this year has grown. I think it's fully priced in for December. So not good for those that are sort of looking for the interest rate cycle to have peaked. And it's a similar sort of story in Australia, isn't it? From having a look at the numbers yesterday, the blowout sort of number for Australia has now seen money markets sort of pricing in about an 80% probability of a hike for the RBA. So not exactly the Christmas gift that many struggling families, I think, would have hoped for in Australia.
No, indeed, that is not great news. Well, let's turn to what we're seeing locally then, Matt. Obviously, reporting season, we're coming close to an end. This is the last full week, of course, and got more big results coming to us today. What are you seeing on the local market at the moment? What's actually been driving that? I mean, some of those results, we've seen some really volatile moves.
Yeah, which is pretty normal, I guess, in reporting period. You get companies that miss expectations, and you have that natural sort of reaction, and vice versa. If guidance is well ahead of expectations, you do get those major sort of moves. But I think if we sort of condense a reporting period down to how the broader indices have behaved, it's a tale of two stories really. Is that the financial sector has been hit quite hard, led by the banks, down about 8%. And on the other side of that, you've got the healthcare stocks that are in a huge recovery. I think the healthcare sector in general is up about 20%, certainly led by CSL. And again, that bid for materials just continues to soar with BHP going through all-time highs, and the materials index up about 15%. Part of that's driven by gold. Gold's obviously sort of broken out from that $4,000 range, and all those gold stocks are up 35%. For the gold mining investors, and we're certainly in our growth fund have a pretty good share of gold miners. Expect a weaker sort of day. Gold prices did move off highs yesterday. I think that was on the back of that inflation report, and perhaps a stronger US dollar. So I expect that gold miners will sort of move lower today. But to come back to that question, I think reporting periods largely been less about underlying fundamentals. I don't think there was anything particularly wrong with the banking results. Yes, I think provisioning has to move a little bit higher, and that's reflective of where we are in the economic cycle. But the CBA result for me was bang in line with expectations. It's just that the stock was trading at all-time highs from a PE multiple perspective, and perhaps the market's no longer prepared to sort of pay that type of premium for CBA, given that the earnings outlook is okay, but it's certainly not exciting.
Just in relation to mining, obviously got the mining services company Monadelphous. What have you made of that?
Yeah, that was one that's really sort of caught our eye. It's one that we hold in our growth fund, and one that we're looking to accumulate further on the results. I think headline result was really robust. NPAT growth of 52%, revenue up 31%, operating cash flow, the feature really strong, and a healthy dividend for investors out there. But the stock did trade about 12% lower on the results, on what appeared to be for us conservative guidance. So what's the bullish sort of view from a Lincoln Prime perspective? Look, I think that the market is probably anchoring too heavily on the fact that the FY26 maintenance result was unusually strong, and therefore assuming that earnings are likely going to come off from a cyclical peak. And although we're probably comfortable conceding that maintenance revenue could be flat on the year because it was so strong in FY26, I don't think that's the right way to think about Monadelphous. I think the opportunity is in that engineering construction space, and Monadelphous has spent the last few years deliberately broadening its capability through these bolt-on acquisitions. It was Kerman, APIP, and High Energy, and that's allowing it to grow much larger and more multidisciplinary with projects rather than their traditional mechanical construction projects. So the evidence is there. The engineering construction revenue grew almost 50% in FY26, and I think they're extremely well placed to win more work as the year progresses. So management are notoriously quite conservative with regards to how they guide. And they, or in their outlook statement, they didn't provide any concrete guidance. But I think the market sort of reset here. I think there'll be, progressive earnings revisions higher this year, and I think the stock is reasonably priced.